EV tariffs in Europe. And of course, as is typical, following on the heels of any move from the Fed, we do have the Hong Kong Monetary Authority cutting its base rate to 5.25%. Now, this is also quite interesting in the sense of what the implications are going into the next few months for the Hong Kong dollar. Bloomberg Economics expecting that the prime rate could still hold until 2025, the Hong Kong prime rate, that is despite Fed rate cuts, but certainly some of that pressure could be alleviated when it comes to rate differentials. There's some concern that the dollar peg for Hong Kong, which is of course why we see that sort of following of the Fed, could be targeted if former President Donald Trump wins the re-election, implements that old proposal to limit Hong Kong's access to the greenback. But economists do expect that the key driver will be rate differentials for that Hong Kong dollar spot rate. So watching to see for a drop given the move from the Fed, Sherry.
Yeah, when we saw the greenback really paring back some of those earlier declines, really the question about the Fed with this outsized 50 basis point move, was this a really reactive sort of action given that the economy is already slowing at a faster pace than the policymakers want to see? Or is it a proactive move in order to really avoid that sharp slowdown, right? I mean, the Fed is trying to portray it as a very proactive move. They want to get ahead of the curve, but at the same time, of course, those doubts remain. Take a listen to exactly what Chair Powell had to say.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
What is really interesting, of course, is looking at the dissenting vote on this decision, right? Michelle Bowman putting through that dissent. This is relatively rare when it comes to Fed decisions, casting the first dissenting vote by a Federal Reserve governor since 2005 here. She preferred to cut rates by a smaller amount during the policy meeting on Wednesday. Of course, they cut by half a percentage point. She was in favor of 25 basis points, according to a statement by the Fed. She has really been on the cautious side when it comes to disinflation. In August, she said that price growth remained uncomfortably above the Fed's 2% goal. She's been arguing for the gradual lowering of the Fed's fund rate. So this is quite interesting, saying that, given the backdrop of just how unusual it is to have a dissent, particularly during Chair Powell's tenure. The last one was in June 2022 from Esther George, who dissented in favor of raising rates by a smaller amount. So interesting that perhaps this is not kind of a broad consensus even within the FOMC, Sherry.
Yeah, really that debate between gradual moves or really front-loading the easing cycle from the Fed, right? But take a look at how we're setting up for the Asian market opens, because, of course, Japanese equities were under pressure for the last two sessions because we had a strength in the Japanese yen. We continue to see a little bit of that strength, but still hovering at around that 142 level. So after two sessions of losses, we are seeing Nikkei futures pointing to a little bit of upside. Sydney futures, though, slightly down. We did get New Zealand second quarter GDP numbers. Yes, again, contraction, but contracting by a lesser amount than economists had expected. Really, offshore yuan not doing much. We'll be watching those moves by the greenback. Take a look at how U.S. futures are coming online in the Asian session, because the U.S. dollar pared back some of those earlier declines. A lot to do with the function of what treasuries were doing, because that rally that we've seen in the past couple of weeks really took a breather today again, and we had the 10-year yield sitting at around that 370 level. But take a look at U.S. futures right now. We had seen it really rally about 1% for the S&P 500 when the decision for that outsized rate cut came out. But as we heard Chair Powell speak, and we got the sense that really he was in no rush to continue easing at this pace, we actually had U.S. stocks falling, treasuries falling, also treasuries rising as well, and then we had the dollar falling. Heidi.
Yeah, Sherry, let's get some more perspectives from our next guest. Dana Peterson is the chief economist at the Conference Board. Dana, great to have you with us. And, clearly when you talk about this first dissent from a Federal Reserve governor in almost 20 years from Michelle Bowman, there was clearly a lot of discussion as to the right path forward, right? Do you think the Fed got it right? I know you were in the 25 basis point camp as well.
Yes, we were in the 25 basis point camp because we felt anything greater than 25 basis points would signal if there's something wrong with the U.S. economy. However, I think the Fed really tried to thread the needle today, or on Wednesday, and basically provide something for everyone. Yes, they cut interest rates by 50 basis points to address the naysayers, who are the doomsday sayers who say that the U.S. is on the cusp of recession. But then the Fed spent a lot of time talking about how strong the U.S. economy really is. Growth is solid, the labor market is okay, and also inflation is cooling in line with their expectations back to 2%. So with all of that, I think the Fed definitely did compromise here, but I don't see there's any big concern from the Fed that they need to continue to cut interest rates by 50 basis points meeting after meeting. They're going to be moving slowly and gradually.
The dot plot really suggests that this is, proactive but gradual, a start rather than a trend, right, in terms of what to expect. If you take a look at markets, so traders are pricing in a lot more aggressiveness from the Fed. So do we expect to kind of continue to see this dislocation? And to what extent was this kind of Fed Chair Powell and the FOMC wanting to, put something out there that made everyone happy?
Well, I think the key thing is that the Fed is continuing to say that it is data dependent. So incoming data are going to help them to determine how quickly they're going to cut interest rates and by how much per meeting. Indeed, Chair Powell and even the policy statement indicated that the Fed may wait a meeting, they may skip meetings, they may pause, they may do a lot one meeting or a little another meeting. They're just really leaving it up to the data. So if we continue to see that consumer spending and consequently GDP growth in the third quarter was healthy and strong, and also we don't see any further material weakening or slowing in the labor market, and inflation continues to trend back to 2%, probably getting there sometime next year, I think the Fed can feel comfortable cutting gradually, another 50 basis points this year, according to the SEP, and then another 100 to 125 basis points next year.
How big of a story was the dot plot, given that really traders still expect more easing than FOMC officials at this point?
Well, I think traders are, pricing in. They like to price in everything and expect everything to happen right away. But that's not how the real economy works. In the real economy, inflation is still above the 2% target. Prices are still quite high. And interest rates need to remain at at least have a degree of restrictiveness to continue to push inflation downward. There are a lot of upside inflation pressures, including higher costs for labor that companies are passing on as baby boomers retire, and they have to raise wages to attract and keep talent. Also, we have a number of issues with housing. We don't have enough housing supply in the U.S., and so home prices are elevated, and that's putting upward pressure on consumer inflation gauges. You also have deglobalization, where companies are bringing back their supply chains from abroad to the U.S. All those things cost money, and those cost increases are going to be passed down to the consumer. So the Fed needs to make sure that it carefully calibrates the deceleration of interest rates, or the cutting of interest rates, to make sure that inflation does not rear back up and resist all the work that it's been doing.
Yeah, I was going to say, is inflation in the back burner right now, and how big of a risk is that?
Well, I think the key things is that most of the inflation we're seeing, or nearly all of it, is in services. And a big chunk of it is housing and shelter costs. Now, we know that home prices and also rents have decelerated in the U.S. in the past, but it takes about a year and a half for it to show up in inflation gauges. So little by little, we are seeing shelter costs slow. But even Fed Chair Powell said that shelter costs are slowing not as quickly as anticipated. Then you have other services costs that are rising. Indeed, insurance costs are very elevated for healthcare, autos, and also for homes in the U.S., and that's putting upward pressure. And then finally, again, back to labor shortages. Many companies are having to keep wage increases elevated and also offer bigger bonuses and benefits. And all those things, again, are going to be passed down to the consumer. So that's why we haven't seen inflation drop back to 2 overnight, and it's going to take some more time to get there.
There's been a lot of discussion about the FOMC's reaction function and whether we're seeing more of an emphasis on unemployment. Did we see that in the narrative at all in this decision?
Well, they gave mixed news on the labor market. On the one hand, they said that they are concerned about the downside risks to the labor market. Indeed, in the Beige Book, a number of regions in the U.S. said that they're seeing cuts in hours. Also, when you look at payrolls, we had data from the QCW database that suggested that non-farm payrolls over the last year or two have been stronger than expected, and indeed will be downwardly revised. So that's the negative news. But then the Fed said, hey, look, the unemployment rate is still very low at 4.2%. And indeed, their outlook for unemployment only edges up a few more tenths of a percentage point to 4.4%. And 4.4% is really, that's the natural rate of unemployment. That's the point where the labor market is not either generating inflation or generating disinflation or deflation. It's kind of the Goldilocks spot. So the Fed is saying, on the one hand, we are concerned that the labor market could weaken further, but right now we don't really see anything that's really disconcerting about the labor market.
Dana Peterson, chief economist at the Conference Board. We do have more reactions to the Fed's jumbo rate cut coming up on the Asia trade from across asset classes. Circle's CEO joins us to explain the impact on crypto and stablecoins. Plus, Nikko Asset Management gives us their economic overview, and we check the fallout for FX markets with RBC.
And coming up tomorrow, Sherry will be speaking exclusively with the New Zealand Prime Minister, Christopher Luxon, as the country's economy teeters on the edge of its third recession in 2 years. Do join us for that conversation at those times on your screen. Plenty more ahead. This is Bloomberg.
Bringing you up-to-the-minute technology news whenever and wherever it happens. I'm Annabelle Drawlers in Taipei, and this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Shorting a stock purely because you think it's expensive is a death wish.
These are companies that are growing their market.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Weekdays at 9 a.m. Eastern, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about.
Here's the headline. Fed cuts interest rates by 50 basis points, and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually a steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
We would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good.
Some of our guests are reacting to the Fed's 50 basis point rate cut. Let's bring Garfield Reynolds, who leads our markets live coverage in Asia. And I don't know if we talked about whether you were in, camp 50 or camp 25 going into this decision, but it feels like the Fed has tried so hard to thread the needle, if you will.
Yeah, very much so. And I think ultimately this came down to the growing concern that if they're going to act, they need to act decisively. It was notable, Powell saying if they had known what the jobs report ultimately delivered for July, when they met in July, then they would have cut then. So in some ways, this is sort of them going, oh, okay, we should have cut in July and then cut in September. We didn't cut in July, so we've got to do 2 in September. And I think that's the way to comprehend what Powell meant when he said, just because we've gone 50 this time, don't expect us to go 25 each time. He's sort of stealthily admitting that they got a little bit behind the curve, but he doesn't think they got far enough behind the curve that they can't fix that by doing 50. Now it's back to 25 basis points for the next 2 meetings, provided the data continues to stay where it is. They're very much in data-dependent mode. So if we get significantly weaker employment reports, or if we get significantly stronger employment reports, or a significant tick up in inflation or inflation pressures, that will change things going forward. The weaker jobs market, that would put 50 back on the table for either November or December. A stronger jobs market and or some inflationary pressures coming through, that would have the Fed thinking, well, maybe we don't need to go at both of the remaining meetings this year.
There's a big gap to be closed then between what Chair Powell is saying, what the dot plot is showing, and what the market is thinking.
Yeah, very much so. And the summary of economic projections showed some level of concern about the economy, a sufficient level to potentially justify more rate cuts than ended up being there in the dots, and it certainly didn't necessarily justify the reluctance with which it seems that they faced in going 50. But that even so, what the Fed is seeing does not match with what the bond market is seeing. And that's why bonds, equities fluctuated yesterday. Bonds pretty clearly moved lower. Yields went higher. So that tells you that the Fed is out of sync with where the bond market thinks rates should be going.
A lot of profit taking as well, right? Given that we saw the 5-month rally in the Treasury space. But I wonder, given that Chair Powell continued to say that the economy is, quote, basically fine, what does that necessarily mean for the fact that they still went ahead and did this historic 50 basis points cut, which is usually linked to economic crises? What does that mean for the markets, I guess?
Well, I mean, it means for the markets that the path is actually very uncertain, especially, if they'd cut 50 and signaled, and sort of accepted that they were going to be cutting at that sort of pace fairly often, then yes, that would be them saying, oh dear, we're heading for a recession, or, well, we're in danger of entering a recession, and so we are willing to do whatever it takes. Channel the old Mario Draghi stance a bit. On the other hand, if they had gone 25, then they would be, just clearly saying, hey, that would be a full endorsement of the idea the economy is doing just fine and that the soft landing is clearly in front of them. So I think that helps to explain the way equities, fluctuated. They rose as much as 1%. They closed down 0.3%. Futures today are up about 0.3%. So they're kind of back to flat, back to where we were before the Fed cut. So the equities are facing a bit of an uncertain outlook. Because that question, soft landing or no, is still a very difficult one to decide. I think the one caution too going forward is that the Fed has a history of however strongly or otherwise it starts off its rate cutting cycle, it starts its rate cutting cycle thinking that it is in the process of engineering a soft landing, and and then it runs into something like Lehman Brothers, like the ultimate meltdown that came in the wake of the dot-com bust. That means it has to cut far further and faster than it had anticipated.
Garfield Reynolds, who leads our Markets Live coverage here in Asia, as we reacted to the jumbo-sized Fed rate cut there. You can get, of course, much more when it comes to looking ahead to the BOJ decision on Friday. TLIV Go with that commentary and analysis from Bloomberg's expert editors. More ahead on the Asia trade. This is Bloomberg.
Names that move markets are on Bloomberg.
I am a huge believer in trade. I believe that the benefits, the dispersed benefits to American consumers of trade are huge and important, and we've all enjoyed them. What is true is that the Chinese economy is doing something strange. They are leading the manufacturing of almost every clean energy product: wind turbines, solar arrays, batteries, EVs. But what's also true is they're by far the biggest polluter in terms of carbon emissions. And they're using their carbon emissions to try and drive their economic program of leading this energy transition to pull their very weak economy out of the ditch. So in fact, the idea that they should be charged for their emissions that are about a third of global emissions makes very good sense to me. And we're doing it in a not direct way, but it's actually a way that turns out to be pretty fair.
Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Obviously, the logic of making all these devices explode, indication that this event confirms that there is a serious risk of a dramatic escalation in Lebanon, and everything must be done to avoid that escalation.
UN Secretary General Antonio Guterres is speaking ahead of a high-level session of the General Assembly. Well, Iran is threatening to retaliate after its ambassador was wounded in a wave of explosions that targeted pages and other wireless devices in Lebanon. Hezbollah, the Lebanese government, and Iran all blaming Israel for the near-simultaneous blasts. Meanwhile, Israeli Defense Minister Yoav Gallant ushered in what he calls a new phase in the war in the Middle East. Bloomberg's Michael Heath joins us now for more. And certainly, if it is Israel, this is just so audacious, this series of attacks.
Audacious is the word, Heidi. Yeah, I mean, it's just extraordinary. And these low-tech devices, whether it be walkie-talkies or pages, it's just so unexpected. But it does feel like we have entered a new phase. And the question sort of seems to be, is Israel sort of testing the resolve of Hezbollah? I mean, Hezbollah is a serious organisation. It's dangerous. It's the most dangerous of the sort of axis of resistance, excuse me, that surrounds Israel and is sponsored by Iran. But both Iran and Hezbollah are already due to retaliate to Israel and haven't really done so far. So it's a real question then how they respond to this, what they do or whether they hold their fire for now again.
You rightly talk about, we were trying to work out, whose turn is it to retaliate, right? And there has been a sense of restraint or, really strategic ways of retaliating without threatening a region-wide conflict, right? What is Israel trying to achieve potentially by doing this in such a brazen way?
Well, it almost seems like Israel's trying to see, do they just talk but not walk the walk, Iran and Hezbollah? Because as you say, I mean, they're sort of due to retaliate for the assassinations that occurred. Obviously, the head of Hamas in Tehran and a senior Hezbollah official in Beirut. And so if nothing happens after this, then the question is, are they afraid of Israel, or are they just determined to wait until the timing is right for them? The question though becomes that if they retaliate, then how serious does it become? Because if Hezbollah fires missiles, say, into central Israel, that's almost certainly a case for Israel to more seriously respond, and then we deteriorate probably into war, and we've got that wider conflict we're talking about. Israel and Hezbollah have been waging a sort of proxy fight where they're firing missiles at each other, but near the border regions, which has required the evacuation of people on both sides. And one of Israel's points is it wants to get its people back into those border communities, and so it wants Hezbollah to pull back. So again, it almost feels like Israel's, number one, it's showing that it's vulnerable to Hezbollah, but that it's testing its resolve.
Bex Michael Heath there with the latest as we continue to watch developments in the Middle East. More ahead on the Asia trade. This is Bloomberg.
We actually have we're not done when it comes to central banks, right? I mean, we do have the BOE, we have also the Bank of Japan, of course, on Friday. U.S. futures pointing to the upside of 0.3% after we saw a session of losses. There was a lot of volatility up and down, as investors were trying to gauge where the Fed goes from here. Bloomberg opinion columnist Bill Dudley says he expects another rate cut in November. The former New York Fed president also told us the central bank has successfully delivered a message that today's 50 basis point move was based on good news, not bad.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good. We've made progress on inflation, as opposed to we're doing this because the news is bad. So I thought it was a very, he's providing reassurance to people that the Fed thinks that they've got it. Also, when he's asked about, the SOM rule and the risk that the unemployment rate could go up by quite a bit more, pretty reassuring on that. Thinks that the labor market can stabilize close to where we are today. And that's really hugely important because, if the labor market doesn't stabilize, then we will have a mild recession, and then the Fed will have to ease a lot more. So I thought the general tone of the press conference and the statement was, we've got that. We've got it.
Bill, congratulations. Your essay today, you'd think you were one of the Fed whisperers everybody's talking about out there right now. Bill Dudley, I look at where we are and where we're heading, and it simply comes down to the strength of the American economy. Forgetting about the theater of recession, where does GDP settle? Whether real GDP or nominal GDP, how do you envision that in a year or even 2 years?
I think if you look at the Fed's forecast and look at how that growth affects the unemployment rate, the Fed thinks that, growth in the medium term is going to be 2%, 2% plus at an annualized rate. So, and that's sort of what we're doing right now. So, the Fed's got a sort of soft landing in place. If the economy continues to grow at the same pace as it's doing right now, the unemployment rate will stay relatively stable. You saw in the summary of economic projections, the Fed shows a very modest further increase in the unemployment rate from 4.2 today to 4.4%, but nothing beyond that. So it's sort of a soft, if you look at their forecast, it's a soft landing kind of story, and I hope they could pull it off.
Bloomberg Opinions, Bill Dudley there speaking with our colleague Tom Keene. Take a look at the crypto side of the reaction to the jumbo-sized Fed rate cut that we had overnight, and we had a pretty favourable reaction overall, Bitcoin rising and some of the other crypto gains after the Fed cut for the first time in 4 years, of course. We are seeing a little bit more of an upside there, about 1.7% of the upside for Bitcoin, and of course some of these riskier assets really kind of benefiting. We saw an initial bump of about 2% for Bitcoin. It'll raise that increase, but it's still kind of sitting just over that $61,000 level. Let's get more on this from Singapore. Our tech reporter Annabelle Jewellers is there with our next guest, whose company issues the world's second largest stablecoin, Bell.
Thanks, Heidi. Yeah, joining us this morning is Jeremy Allaire, Chairman and CEO at Circle. And Jeremy, I guess that Fed rate cut really kind of is sort of a double-edged coin for you guys, because at the one hand you're of course you lose possible source of income when the Fed cuts rates, given you've got that money that can't be put in and made to work as much with a lower rate. But then at the same time, you've got that interest that can build for more speculative assets. And even though perhaps a stable coin isn't necessarily a speculative asset, it still sits within that sort of broader basket of cryptocurrencies. So what is your reaction to the Fed rate cut?
So my view is lower interest rates are critical to both the real economy, but also to the investment economy, meaning how people invest, the amount of capital that kind of comes off the sidelines and gets put to work in investing in assets, investing in growth. And the sort of ideal neutral interest rate, which apparently is around 2.9% according to the Fed dot plot, that I think would be an excellent interest rate. And what we want to see is more money velocity, more utility for money in the economy, and I think lower interest rates definitely support that. And so we think this kind of move down in rates should be a really positive catalyst for growth and adoption in stablecoins.
Growth and adoption, I think, also speaks to sort of what's been one of the major themes at Token 2049 this year, which is sort of searching for that next narrative for the industry as well, and also looking for that mainstream breakthrough. What's the point, do you think, where stablecoins actually enter the everyday lexicon for people?
Yeah, I mean, in some parts of the world, it is very much in the everyday lexicon. If you go to Argentina, it is in the everyday lexicon. If you go to some markets in countries in Africa, the same thing. And so it's fascinating to watch how this technology gets adopted in different parts of the world. But I think uniformly, 2024 has been the year that stablecoins kind of decoupled from the rest of the crypto market in terms of transactional growth, in terms of active users, all these things that are indicators of utility. We've seen that, and we've seen that in the numbers, and we're certainly seeing that in our business, where the demand for using stablecoins, which are essentially just digital dollars that work as efficiently as the internet, which is to a person who uses them super intuitive. That has started to really grow in international markets, in emerging and developing markets, SMEs, individuals, households, firms, adopting this as just a better way to store value and a better way to conduct transactions and international transactions. So we're seeing that happen. I think there's certainly in the mainstreaming of all this, these are kind of like what I'll call like early adopters who figured it out. The real question is what's necessary to get us to much broader scale mainstream adoption all around the world.
And I guess part of that also depends on the amount of regulatory clarity that you can gain for the industry as well. What are you seeing in the US, and how dependent do you see that as well being on the outcome of the US election?
Yeah. So legal certainty on the treatment of stablecoins as a kind of legal electronic money is really critical. The good news there is that in almost every financial market center in the world today, there is active stablecoin legislation or laws that are either going into effect or are very close to going into effect. And so that's, here in Asia, Japan, Hong Kong, Singapore, UAE, the EU, which is already in effect. USDC, the digital dollar issued by Circle, is in fact now issued as legal electronic money in Europe. And so that's clarity that's really, really powerful. In the U.S., we have to get through this presidential election, obviously. And, I think there's rhetoric about, pro-crypto or, being pro-business entrepreneurship innovation, which is sort of the language we're hearing from the Harris campaign. But on the ground, when you go actually look at the work that's been done, the Payment Stablecoin Act, which is the primary legislative vehicle, it's very nonpartisan. It's got strong support from Democrats, Republicans, and so I think that's going to be a piece of legislation that moves. And the rest of the world is waiting on the United States to put its, rule book down and say digital dollars that are privately issued that work as money in the financial system. Here's the framework. Let's go.
Do you see that solution continuing to be led by the private sector as well? Because, for instance, you've been quite public in linking the need for regulatory certainty and progressiveness on that front to ensuring the continued dominance of the US dollar. But what is the risk then that you also have more public sector solutions as well? For instance, Wyoming is one that's looking at issuing its own stablecoin now for the state.
Yeah, I think experiments are experiments, and I don't have much to say about that particular instance. But in the West, and in many other parts of the world, but certainly in the United States, free market competition, private sector technology innovation, and well-established rules and regulations are kind of how the system's been built. And whether that's in the development of the internet, the development of self-driving cars and electric vehicles, private space travel, and certainly areas like crypto, and even in other parts of the payment system, almost all the kind of payment technology, payment system innovation has been private sector led really for the last 50 years. So I think there's an inherent understanding that the private sector can move much faster, improve technology much faster, reach the ultimate end users most effectively. But what's critical is that because a stablecoin, a dollar stablecoin like USDC, is a form of money creation, in Jay Powell's words, it needs to have a Federal Reserve set of kind of standards around it, right? And that's what's going to give everyday institutions and people confidence that, there's sort of ACH bank money, there's stablecoin money, there's these different forms of electronic money, and people need that conveyance to be able to say, hey, I'm going to use this for anything in my world.
Just quickly, of course, you're in Singapore, and there's sort of four main crypto hubs we can think of within Asia: Singapore, Hong Kong, Tokyo, and Seoul as well. Where do you think you're seeing the most progress right now on the stablecoin front?
Well, right now, in terms of regulation, Japan is far ahead. They're far ahead of any country in the world, in fact. Almost 2 years ago, they put in place, over a year ago, I should say, they put in place their stablecoin laws. It's very thoughtful. It creates a way for foreign issued stablecoins like USDC to be able to function there. And we've made some announcements about our intentions and what we're planning to do with bringing USDC to Japan under the regulatory regime they've established. So just narrowly for our business, like Japan is sort of has moved ahead. But both Hong Kong and Singapore are very actively working on this. There's frameworks that have been out for consultation that are going to legislative drafting, and so I don't know if it's a race or whatever, but like there's real effort there. But more broadly, Singapore continues to make a lot of progress in licensing and attracting a lot of firms globally, and I know the industry broadly is excited to see what emerges merges with Hong Kong, who's now obviously been granting more licenses and trying to continue to support this agenda.
All right, Jeremy Allaire, thanks so much for your time this morning. That was the CEO at Circle there, Sherry.
Right, Annabelle Jewelers there joining us from Singapore. As we have breaking news at the moment, Bloomberg now has learned that Ampere Computing is exploring a potential sale. According to people speaking to Bloomberg, the semiconductor startup backed by Oracle has been working with a financial advisor in recent months to help field takeover interest. Now, we're being told that Ampere is open to talks with a larger industry player about a possible transaction. Remember, the company back in 2022 said that it had filed confidentially for a U.S. IPO. The firm was valued at around $8 billion at that time, and this move could suggest that Ampere doesn't see necessarily an easy path to that initial public offering. So we're now being told that it's exploring a potential sale. Coming up, senior U.S. economic officials are due to meet with their Chinese counterparts in Beijing today. Details coming up next. This is Bloomberg.